Hello, my name is Jim Penn. I'm the Manager of Retirement Services here at VectorVest, and I wanted to take just a moment and talk about building and managing your retirement portfolio in these uncertain times. Now, it's our mission here at VectorVest to do our very best to show you that you can retire with a peace of mind knowing that you can steadily grow your portfolio, generate income, and preserve your capital. I've had many conversations with our founder and mentor, Dr. Bartolito, about how we can best meet the needs of our clients when it comes to retirement-minded investing. And I relayed to him that the question I always got on the road talking to our subscribers and our customers about their needs, and the question always boils down to, in some form or fashion, how do I keep from running out of money in retirement? And in only the way he can do, Dr. D just told me, he said, James, tell them to just keep making more money. And it is towards that end that we have built the 3 core strategies that we believe every investor must know to retire with that peace of mind that I talked about earlier. It begins first with capital appreciation, growing your portfolio with high quality, safe stocks. The next core strategy comes from income, whether it's through quality dividend stocks or selling covered calls. And then finally, and most importantly, as we have witnessed over the last 5 or 6 weeks, is capital preservation. Let's start with capital appreciation. Now, the process that we use to build and manage your retirement portfolio, we say revolves around the 3 P's. The first is profit, meaning capital appreciation, and that comes from stocks with consistent and predictable financial performance. And I often say, what 2 better adjectives to define the stocks that reside in your retirement portfolio than consistent and predictable when it comes to financial performance? There's a checklist that each company has to fill before it meets the parameters for our portfolio, and they consist of these 6 specific pieces of information. We're able to funnel information through the VectorVest program, and the formulas and algorithms will give us the actionable information that we need to be successful. Now, you can go out and find a lot of that information on your own, but I guarantee you, you will be buried by the data that you have to plow through to get that information. So what we've done here at VectorVest is create one single indicator that looks at it all. And that indicator is called relative safety, or RS. As we see here in the column. It's on a 0 to 2 scale in the VectorVest program. Anything at 1.4 or higher is considered excellent on that scale. And we have a search called ruler stocks built into our Unisearch program with some very basic parameters that tell us the earnings growth rate has to be at least 14% per year, and the stock's relative safety has to be greater than or equal to 1.4 just to make it on the list. And as you can see, some very well-known companies are listed here, and this is just one way to get right to the top of the list of the safest companies in the VectorVest program. In fact, what we've done is create an entire growth portfolio that we look to manage based on high safety stocks. This is a portfolio called Ruler Stocks. It uses ProfitLocker Pro as its management technique. This particular portfolio is over a 3-year span, so it includes early 2018. If you remember the drawdowns we saw then, we had them again at the end of 2018, and of course what we're going through now. Now you'll see there are no positions currently in this portfolio. We're totally in cash. The portfolio over that span, which encompasses many different market climates here, is up over 80%. Now, when you annualize that out, that's 24.6% annualized rate of return. And then just to put that into some perspective, over the same time frame, the S&P 500 is up a total of 6.61% annualized rate of return as of April the 7th. So again, just to put that in perspective on the powers of finding the right stocks at the right time and implementing the proper risk management techniques. After capital appreciation comes income. And we talk about income, and that second P of the 3 P's I commented on is provide. We want to be able to provide a steady, safe income flow. We do that through both dividends and covered calls. So let's look at part 1 of that steady income flow. First, we'll look at the characteristics of quality dividend growth payers. Earnings growth rate, because what good is a dividend if the company cannot continue to earn enough money to pay that dividend? We want to be sure that dividend is growing, and then of course the safety of the dividend. VectorVest has many places we can find these quality dividend payers. In the Viewers tab, when we come to our watch list viewer, there is a dedicated folder to dividend paying stocks. And you'll see several choices here. I've gone right to the DRIP 25 plus, that's dividend reinvestment plan. 25 plus simply means that the stocks that make this list have not only paid but have grown their dividend every year over the last 25 years. And again, well-known names that we see here. We also have DRIP 10 to 24, so companies that are working their way up to what's referred to in the industry as the dividend aristocrats, or those 25 plus years. We also have built into our Unisearch tool, we have a search called Blue Chip Dividend Payers. Again, this is one of several great strategies to find quality dividend paying stocks. This is one that we model and trade in our retirement coaching group. And when we take a look, this is the type of stock we were talking about. This is Lowe's. This is one of the top stocks from the DRIP 25 plus. What I have is roughly a 10-year look back at the stock. And if we look at the bottom, these are the dividend increases here, represented by what I call the golden staircase. They just continue to grow their dividends every year. Now, no stock is going to go straight up. Again, we have drawdowns on the stock, certainly given the current market conditions. But when we focus on a portfolio that provides income with dividend growth, we can see a nice steady movement. So we also got capital appreciation. And yes, we had the drawdown, just like we did in ruler stocks. And when I get to core strategy number 3, we'll talk about how to mitigate those losses. But what we're looking at is a much longer term outlook when we talk about dividend paying stocks. So this one goes out just a little over 7 years. That's an 89% return. What that 89% does not include in its 12.31% annualized rate of return is the $30,000 or more than $30,000 in dividend payouts that we have taken in this portfolio. So add just over another $30,000 to that number, and our annualized rate of return then goes to 17%. And even that doesn't include reinvesting the dividends that we received. Again, we are in cash. Our risk management plan has left us in cash during this drawdown, and we'll talk about how to mitigate that drawdown. Now, to put this portfolio in perspective, it's a longer term outlook from January of 2013 to the present time. The S&P 500 is up 11.8%. We compare that to a very prudent portfolio, in this case the blue chip dividend payers, and we're up just over 17% over that same time frame. Part 2 of our strategy to continuously have that safe, steady income flow comes from covered calls. So let's talk about part 2 of our provide section. Let me take you through just one example of many from our retirement income portfolio, again, that we manage in our retirement coaching group. This is just since June of last year, with just one position that we have been able to profit from 5 different times selling covered calls, or doing what's called the buy right, where the objective of the trade is simply to generate income. This is a little over a 6-month time frame. Since late February, we have not done any covered call or buy right trades because of the market conditions. So it's a bullish trade. We wouldn't do it in the current market condition, but we're up over $3,000 and counting on just AMD alone. And here's kind of the history of buying shares of the stock, 200 or 300 shares at a time, and selling covered calls and generating income. Remember, someone is willing to pay you today to take your stock away at a higher price at a later date. It's the definition of a covered call. And so here's that quick history of the last 6 months. We were able to bring in over $600 in 31 days. That's a 6.8% return. A couple of weeks later, we did it again. Over 28 days, we brought in 7.5% return on investment. After populating our buy right portfolio with some other good quality stocks, a few weeks later, AMD made the list again. 28 days, another 4% return on investment. And this is all again in roughly a 6-month period. So a great way to bolster that steady income flow using a very popular, very easy option trade to implement in your retirement account. Finally, and as I said earlier, most importantly, we have capital preservation. Here we're talking about preserving your retirement nest egg. Let's start with protective puts. The goal here, of course, is to protect your assets. What's the best way to do that? Well, to reduce risk, we can go out and buy put options to protect individual stock positions or your entire portfolio. Let me be clear, you do not need to be an options expert to implement the two very basic, very popular trades that I'm talking about. You don't need some advanced course to understand it, but these are trades that I believe are essential if you are building and managing your retirement nest egg. We'll also talk about the collar trade. The collar trade is simply the combination of a covered call and a protective put. I'll go ahead and illustrate each example here for you. Fidelity National is a company in our model portfolio that back on January the 22nd we purchased because the market was in a confirmed up call and we had a slot to fill in our retirement portfolio. We ran our process to find the proper stock and Fidelity National came up and we purchased that stock at $47.56 on January the 22nd. Because we do our due diligence on every stock we own, we knew that earnings were to be reported on February the 14th. So what we did as a proactive stance was go out and buy on February the 11th 2 March 45 put options. In other words, we bought the right to sell our stock at $45 per share and we paid $1.05 per share or $210 for 2 contracts. Remember, the value of a put option rises when the value of the underlying stock falls. All you need to do is think of it as an insurance policy. That's all it is. So in this case, the trade took us out to March the 10th when the entire position was closed in our model portfolio. Well, what happened? On that date of March 10th, we went ahead and sold our 200 shares of Fidelity National at $38.52 and on the underlying position lost $1,808. But because we were proactive, recognized the strategic time to be defensive in our portfolio and manage that risk, we went out and bought those put options for $1.05. We were able to sell those 2 put options at $7.30, which gave us a $1,250 profit, which gives us an overall loss on the position of only $558. That's called mitigating your losses and insuring your portfolio. That's an example on an individual stock. Let's take a look at Ross Stores. I talked about the collar trade and the power of the collar trade to lock in unrealized gains or protect to downside moves in the underlying stock. Same scenario, same portfolio. That confirmed up had us go out and buy 100 shares of Ross Stores at $118.05. Earnings were to be reported on March the 3rd. And so once again, we were proactive and went out, and this time we placed a collar trade. Just as in the previous example, we bought a put option. In this case, we bought a March 115 put option when the stock was trading right around 115 at the time the collar trade was placed. That put option cost $3.50. But the collar trade allows us to go out and actually sell a covered call against the 100 shares that we own. And we got paid $1.60 per share. We sold the 125 strike, which is way up here, which means somebody has the right to take our stock away at 125, which is fine. We'd have a nice profit. Plus we get to keep the $1.60 that we were paid. But the key here is that we are now protected and insured to the downside. Well, on March the 5th, this entire position was closed out after earnings were reported and the stock moved down. What happened is that we went out and sold Ross Stores at $102.29, and on the individual stock we lost $1,576. But again, because we were proactive and took action to avoid that drawdown, we were able to mitigate it by selling that put option that we bought at $3.50. We were able to sell it at $13.40. That's $990 profit. We were also able to keep $1.55 of the call that we sold. We bought it back for just a nickel. and we profited on the covered call $155. So remember here, by selling the call option, we were able to put the insurance policy on for just $1.90 instead of $3.50. So it's a much less price that we paid for our insurance. Well, it ended up still with a loss on the position of only $431 versus the $15.76. So these are just two ways that you can protect against those drawdowns that we saw on the graphs of the portfolios just a little earlier. Now here's the other very powerful way to protect your overall portfolio that everyone again who's managing their retirement nest egg needs to understand, that you can simply go out and buy a put option on the S&P 500. That's the SPY, or the ETF that tracks the S&P 500. Here's an example again of how simple this can be. On February the 24th of this year, the DEW timing system in the VectorVest program went to a down situation. That's a good time to become defensive in your overall retirement portfolio. So we placed a put option on the SPY. So whether you're looking to profit in a downtrending market or just being proactive to place an insurance policy on your equity portfolio, understanding how to buy a put option is extremely important. Now that's the DEW timing system. The confirm call went down just a few trading days later, still would have been very profitable for you. Now, how did it turn out? We bought that one SPY April 3/22 strike price put option, meaning that we had the right to sell SPY at $322 per share. Why the 322? Because that's right around where it was trading on the day we placed the trade. So we bought an at-the-money put option. It cost $9.75 per share, or $975 for one contract. That's $1,000, just under $1,000, to protect what in our portfolio was over a $100,000 asset. Just under 3 weeks later, the SPY was trading down at $255. We were able to sell that put option at $71 per share. That's a profit of $61.25 per share, $6,000, or 628% return on investment. Now that's if you had bought that put option anywhere in this range here, and even if you had closed it out in any of these spots, even if you didn't realize that full $6,000, that's still a huge mitigation on the drawdown that, again, we saw in those earlier portfolios that I showed. So not only do our retirement portfolios go to cash as the market is falling based on our exit strategies and our risk management techniques, we're also able to mitigate those losses, again, with very basic option trade of buying a put option as insurance and coupling that with a covered call. So once again, when we see these drawdowns, understand that there are plans in place to mitigate against those drawdowns. So those are the 3 core strategies that we believe every retiree must know if they're going to be successful in growing, building, and managing their retirement portfolio. So remember Dr. D's words of wisdom. How do I keep from running out of money in retirement? Just keep making more money. Towards that end, what we are going to do on Friday, April the 17th, is we are going to have a 1-day live stream session of the Ultimate Retirement Solution course. I'm looking forward to hosting that live from our training center. We will live stream it. You can enjoy the course from the comfort of your home as you watch the live stream. What we do in the Ultimate Retirement Solution course is we take our 6 modules that we use. Again, usually it's our digital course or 6-week course, but we're going to share the course with you in a 1-day session. We begin with module 1, win before you begin. If you don't define your objectives and set clear goals, you're starting off on the wrong foot and you're making your journey a lot harder right out of the gate. So we're going to talk about how to set your goals, define objectives, how we're going to allocate in our portfolio along those 3 core strategies. Module number 2 will focus on capital appreciation, buying the right stocks at the right time, checking off the boxes on how we build that capital appreciation portfolio. Module 3, we'll do the same thing, only this time with a different objective. This one is going to be all about the dividend portfolio, identifying quality dividend growth payers, selecting the proper strategies and setting up that plan. Module 4, for those who might be new to options. The covered call is one of the most popular, one of the easiest trades to implement, and I believe it's essential to your success. In Module 4, we will break down the anatomy of a covered call, the what, when, and how to set it up, and the proper trade management. In Module 5, we'll do the same thing with protective puts and the collar trade. And then finally, in Module 6, we'll actually go in with the full checklist for the entire investment plan for each core strategy, and we'll walk you through the actual implementation of the ultimate retirement solution. Again, it's a one-day live stream. This is coming up Friday, April 17th, 2020 for the Ultimate Retirement Solution course. Now, if you join us for the one-day live stream session, even if you can't join us all day or want to rewatch the video, we will go ahead and give you 1 year access to the course. So you'll have access to the course for a full year after Friday, April 17th. If you are new to VectorVest, we'll give you a 60-day trial to the VectorVest intraday program. It allows you to determine market direction, find the right stocks for our objectives, and reduce the amount of time you need to do. So you get a 60-day trial if you are currently not a VectorVest subscriber. Again, this one-day live stream course is only $495. It's usually $995 is the usual price for our Ultimate Retirement Solution course. For this one-day live stream event, again, that you'll have access to for 1 year, is $495. The question I like to ask, or I believe you should ask yourself, is what will it cost you if you do nothing? How much money will you lose if you're not prepared for these type of drawdowns that we're seeing now? How much potential profit will you miss out on? How much time and energy will you spend trying to do this on your own? And then ask yourself how your life might be different if you do this and it works. It's never too late. There's an old saying that says the best time to plant an oak tree is 20 years ago. The next best time is today. So I look forward to seeing you at our one-day live stream event right here from the VectorVest Training Center. I will be your host for this one-day session on April the 17th of 2020, the Ultimate Retirement Solution course. Please click the link below to go to our registration page. And I thank you for taking the time. Please stay safe, stay healthy, and I look forward to seeing you on Friday.